Now here's the other side of the equation. On Friday, 1.8 billion ounces of silver traded on COMEX. Global annual mine production sits around 800 million ounces. That means more than double the world's yearly silver output are traded in a matter of hours. At the exact same time, the physical market remained tight, with multiple dealers already rationing silver through different mechanisms. Sovereign mints are struggling to keep up. New sovereign mint orders are now running 8 to 10 weeks out. Just 30 days ago, delivery times were closer to 2 to 3 weeks. 8 to 10 weeks out, just 30. I read every comment across our recent discussions, and I appreciate them. It's powerful watching this community use information to make sharper, more deliberate decisions. Some of you are positioned for another leg lower. Others are firmly anchored in the long-term macro thesis. That split doesn't reflect confusion. It reflects preparation. Everyone executing their own plan. That's the core philosophy here. Independent thinking, not herd behavior. We don't sell fear. We don't sell greed. We don't do Netflix-style hype or fairy tale endings. These are real markets with real risk. Especially for anyone new here, that matters. I don't sell signals, coaching, subscriptions, or insider access. Anyone claiming otherwise in my name is running a scam. Block them and report them. My goal is simple: break down what's happening without bias or agenda. I will never contact you asking for money or investments. Protect your capital and protect your information. Now let's break down exactly what happened on COMEX Friday. 1.8 billion ounces of silver traded. That's not a typo. That's roughly 2 full years of global mine production exchanged in a single session. But here's the key detail. After all that volume, the majority of those contracts were closed by the end of the day. Positions were opened, the price was smashed, and then positions were exited. No intent to take delivery. This was paper dumped to crash price and then abandoned. Under normal conditions, monthly volume runs around 100% of open interest, maybe 120% during volatile periods. Friday hit 345%. More than triple normal activity, concentrated almost entirely in the March contract, a primary delivery month. This was unprecedented paper volume dumped specifically to avoid future physical delivery obligations. The data confirms what silver investors have known intuitively for years. This was an unusually aggressive, coordinated event in the COMEX silver futures market, especially in the March front-month contract. 317,238 contracts, equivalent to roughly 1.58 billion ounces, were dumped. That volume alone represents nearly 2 years of global silver production. Dumping that amount during a 40% price collapse doesn't reflect organic market behavior. It reflects deliberate price suppression designed to trigger stop losses, force liquidations, and crush sentiment. Quick pause here. Roughly 75% of you watching aren't subscribed. If this kind of real-time, unfiltered analysis helps you cut through the noise and see the full picture from both sides, consider subscribing. If this adds value, drop "Go Silver" in the comments. It helps keep this channel grounded in substance, not hype. If it's not for you, no hard feelings. I'm not here to chase vanity metrics. Now let's connect this to everything we've discussed all week. Friday's metals crash saw silver down to 31%, the largest daily decline on record. I showed you that JP Morgan closed 633 silver short contracts at the exact bottom. Perfect timing. We discussed Kevin Warsh as a potential Fed chair, anti-QE, rate cuts paired with balance sheet reduction. Markets sold off on that shift away from unlimited liquidity. But here's the deeper truth. Friday's crash wasn't just about Warsh or dollar strength. Those were catalysts, not causes. The Warsh narrative provided cover for the largest paper dump in silver history. 2 years of production dumped in hours. And what happened in the physical market? Demand exploded. SD bullion hit 2.5x their all-time record. This is the key takeaway. When paper silver collapses, physical buyers rush in. Spot price is largely a paper price. It doesn't always reflect what's happening in the real supply chain. Paper markets trade multiples of silver that doesn't exist in deliverable form. That's why you can see paper prices collapse while physical demand spikes, inventory disappears, and premiums widen. SD Bullion COO Cole Keller recently returned from meetings in Berlin with major sovereign mints. The message was consistent across the industry. production capacity is being overwhelmed. The Perth Mint has temporarily shut down new sales on key bullion lines just to catch up on existing obligations. This isn't isolated. Most sovereign mints are facing limited blank supply, higher lease rates, holiday slowdowns, and surging global demand across the US, Europe, and Asia. As of February 2nd, sovereign mint lead times are 8 to 10 weeks, up from 2 to 3 weeks just a month ago. And that gap is expected to widen as Friday's shockwave moves through supply chains. Markets are currently selling metals under the assumption that Warsh will be another Paul Volcker, hiking rates aggressively to crush inflation and restore dollar confidence. That narrative ignores basic math. When Volcker raised rates to 20%, U.S. debt to GDP was, 30%. Today, it's 125%, rising exponentially. The U.S. is adding $1 trillion in debt every 90 days. Interest payments already exceed $1 trillion annually. Warsh doesn't get to choose policy, the debt does. Now add this. The U.S. just announced a $12 billion strategic mineral stockpile aimed at countering China. Lithium, nickel, rare earths. Silver conveniently left unspoken. Yet silver sits at the center of EVs, solar, electronics, and defense. Governments don't hoard resources because supply is abundant. They do it because supply risk is real. Paper prices can be managed. Physical availability cannot. Add India into the mix. India absorbed 25% of global silver production in 2025. Now the U.S. has secured a $500 billion trade deal with India tied to energy, tech, and infrastructure. Silver is embedded in all of it. Demand isn't slowing, it's accelerating. Meanwhile, U.S. ISM manufacturing just printed a 40-month high. Manufacturing is expanding. Industrial demand is rising. Yet silver collapsed 40%. That divergence confirms manipulation, not fundamentals. Current pricing shows the disconnect clearly. Western spot, $80. Shanghai spot, $100. Western futures, $80. Shanghai futures, $95. That's a high 26% premium after a massive crash. Physical markets are not following paper. Yes, the bearish risks are real. Volatility is at 50-year highs. Margin requirements were raised again. Forced selling remains possible. This is brutal for leverage traders, but here's why the physical case remains overwhelming. Paper dumped 2 years of supply in hours. Physical demand surged 250%. Sovereign mints are overwhelmed. Delivery times tripled. Perth Mint paused sales. COMEX registered silver sits at 104 million ounces. If even a fraction of those dumped contracts demanded delivery, the system breaks. Every major bull market has violent mid-cycle corrections. In 1974, gold fell 47%, and then ran 734% over 6 years. Today's pullback is modest by comparison. None of the structural drivers have changed. Debt expansion, central bank accumulation, industrial demand, and physical deficits remain intact. So where does this leave us? Paper markets bought time. Physical markets are tightening. Manipulation is obvious. Desperation is visible. Volatility will remain high. The only unanswered question is when physical overwhelms paper, not if. Understand the risks. Avoid leverage unless you truly know what you're doing. Think independently. This isn't hype. It's math, inventory, and behavior.